Hello traders and welcome back to the Forex Geek, where we dive deep into the tools that can help you make smarter trading decisions. In today's video, we are going to explore the ATR RSI strategy, a method that combines volatility and momentum indicators to refine your entries and exits in the market. You will learn how to apply this approach step by step and avoid common pitfalls along the way. Stay tuned until the end to gain a clear understanding of how this strategy works effectively in different market conditions. So, without wasting any much of your time, let's get started. First, let's understand the concept of ATR and RSI. Let's understand these indicators and what they are made of. The average true range, ATR, and relative strength index are two widely used indicators in trading. Each serve a unique purpose. ATR measures market volatility, showing how much price fluctuates on average over a given period. This is the ATR, this red line, and it should be in the default setting, which is the 14 period setting, and it doesn't indicate the direction of the trend, but helps you understand whether the market is experiencing high or low volatility. High ATR value suggests that price movements are larger and more rapid, while low values indicate quieter market conditions. RSI, on the other hand, is a momentum oscillator that measures the speed and magnitude of recent price changes. It oscillates between 0 and 100, helping you identify overbought and oversold conditions. This is the RSI, and also here the standard input should be 14. This is the standard length, 14 period RSI. So ensure that yours is set to the 14 period, and you can adjust the colors. So when the RSI rises above 70, it signals that an asset might be overbought, while a drop below 30 suggests it might be oversold. These levels can help you spot potential reversals or continuation patterns. If it rises above the 50 line, it could mean that price is moving from a bearish trend to an upward trend, or it could be a potential reversal. So that is that for the RSI indicator. When combined, ATR and RSI complement each other effectively. ATR ensures you're trading in the markets with sufficient volatility, while RSI helps fine-tune your entry and exit points by gauging momentum. For example, if ATR shows high volatility and RSI crosses above 30 from an oversold level, it could signal a potential buying opportunity in a trending market. I'll show you more of that when we are talking about the strategy, so ensure you watch until the end of this video. By understanding how these indicators work individually and together, you can create a strategy that adapts to market conditions while filtering out false signals. So let's talk about the strategy. How can you use these two indicators to trade? To use the ATR RSI strategy effectively, start by setting up the indicators just like I have on my charts, and use a 14 period ATR to measure volatility and a 14 period RSI for momentum. So these are the standard settings, just like I said initially, but you can adjust them based on the asset or time frame you're trading. But I advise you use the standard settings, which is the 14 period. Alright, first check the ATR to confirm market volatility. If the ATR value is rising and above its moving average, indicates that the market has enough movement to trade. Avoid trading when the ATR is low, as this often signals a lack of momentum or range bound conditions. For example, you can see rising ATR here, which shows increased volatility in the market, and you can see reduced you can see lower ATR here, which shows reduced volatility in the market. So that is that for the ATR. Then the next step is to look at the RSI, and this is going to help us take our trade. For a potential buy trade, wait for RSI to cross above 30 from an oversold level, and this suggests that selling pressure is easing and buyers may be stepping in. For a sell trade, wait for RSI to cross below 70 from an overbought level, signaling that buying momentum is fading. So let's quickly look at one example here. On the charts, we are clearly in a bearish trend, as you can see. this is a bearish trend. Very clear. As clear as day, we are in a bearish trend, so we're looking to take sell trades. We're looking to take sell trades to continue the bearish trend. We can also take reversals or pullbacks, but we want to take just sell trades. And looking at it, we have the RSI above 70 signaling overbought conditions, so we should be looking for ways to enter sell trades from here. We also have our ATR at a higher position here, signaling increased volatility, so we should be looking to actually take our trade. Also looking at normal price action, we can see that the market broke structure to the downside here, and this is just a pullback into this zone here. There is an order block right here for price to actually get into. You can see this order block here, so you could just mark this out, and you can see price returning back to this zone to take its trade. And we used this as liquidity to sponsor this move to the downside. Now looking at this, we will be looking to take our sell trade from this zone, so place a short trade here. And the next step is, once both conditions are met, with the ATR confirming volatility and RSI signaling momentum, you can enter your trade, just like I've clicked my sell trade here. But here is the point where we use the ATR to set the value of our stop loss. So for example, for short trades like this, our stop loss is usually 1.5 times the ATR value, and for take profits is usually 3 times the ATR value. You can adjust it based on your preferences, but I like to use the 1.5 times ATR for my stop loss. So how this is calculated is just look at the current level of the ATR at that point in time. For example, this is 0.312. That is the current ATR value at the time when I was entering this sell trade. And with the 0.312, I'll just multiply that by 1.5 to get my stop loss value. Okay, and it's giving me 0.468, and we'll simply adjust this to 0.468. Remember, this is 1.5. You can use 2 depending on your test, your preferences. So 0.468, we have it here. It's close to 0.471, so we'll just keep it at that. Why? For our take profits, we just use the 3x ATR, or in this case scenario, I would like to use the 4 times ATR. So 4 times 0.312, so we have 1.248. So looking at it here, our target is 1.483, so I'll adjust that to 1.248. Yeah, we have 1.24 there. Now this is a 1:2.67 risk to reward trade, and that's how we're able to take sell trade using the RSI and the ATR. Now this is the use of the ATR indicator. We use it to also calculate our stop loss and our take profits, aside using it to measure volatility. So for a buy trade, let me look for another example. For a buy trade, we've talked about the sell trade, let's talk about the buy trades. Now for this, you can see this pullback, we are clearly bearish here. Like I said initially, we are clearly bearish, but also the market doesn't just fall in a straight line. We have pullbacks. And it's expected that the market should give us this push to the upside after prolonged selling pressure like this one that happened right here. And here we can see the RSI giving us oversold conditions right here. Also, you can see the RSI divergence here, with price giving us lower lows, but the RSI giving us higher lows right here, signaling that price we may be looking to reverse to the upside. We'll be looking for a pullback. So after seeing this signal from the RSI, the next step is to look for ways to enter a buy trade. we have this double bottom right here. I'm just gonna draw it out. We have the first one here, the neckline, the next bottom, and the break of this neckline, pull back a bit, and continuation. So this is just the typical double bottom, and we'll just be looking to take our trade at the break of this neckline. And here we are, could just take a buy trade from here. Now looking at this, how do we set our take profit and our stop loss using our ATR? I've discussed this before. At the current time, we just check our ATR, the current ATR at the set time, and it is 0.302. So we'll quickly calculate our stop loss using the 1.5 times ATR, which is 1.5 times 0.302, and it gives us 0.453 for our stop loss. So just adjust this 0.45, and yes, we hit stop loss with this, but that is why it's advisable to use a higher number depending on the market volatility at the set time. So here I'll likely use maybe a 3 times ATR. So we're looking at 3 times 0.302, giving us 0.906. So adjusting it to 0.9, yeah, we have 0.9 right here. All right, that's our stop loss. And for our take profits, we'll be using 5 or 6. I like to use 5 times ATR, and we're looking at 5 times 0.302, so we'll have 1.51. So adjusting this to 1.5, we have it here, and this is 1:1.75 risk to reward ratio, and that's how I would have been able to take this trade. Typically, your stop loss should be placed below the lows, below the previous swing low, like this. But using the ATR is a little bit different. I like to use the ATR to calculate majorly the take profit levels and not necessarily the stop loss levels, because market can still pull back a little bit, range a little bit before moving to your direction. So as a rule of thumb, just place your stop losses below the last swing low or above the last swing high. So that is it for the ATR, the RSI strategy. Common mistakes to avoid is: number 1, relying solely on ATR and RSI signals without considering market context. Now this is a common mistake. For instance, RSI readings above 70 or below 30 are not always immediate signals to sell or buy. As you can see, even after looking at this, I had to check the divergence, I had to check the trend lines, I had to do my normal price action before deciding to take a buy trade all the way to this trend line. So the next is, in strong trends, RSI can remain in these extreme zones for extended periods, leading to premature entries or exits. So always confirm signals with trend analysis or support and resistance levels, just like I did. Another step is ignoring divergence between price and RSI can also lead to missed opportunities. For example, I was able to spot the divergence here, showing that this sell was weakening and we should be looking at a buy pullback, which we are able to catch using the RSI divergence. So pay attention to these patterns, especially when they align with other technical signals. Also, another mistake is over-reliance on ATR and RSI without combining them with other tools. This can result in unreliable trades. These indicators are best used as part of a broader strategy that includes price action, volume analysis, or moving averages for confirmation. So by avoiding these mistakes, you can improve your application of the ATR RSI strategy and reduce the likelihood of false signals or poorly timed trades. Alright traders, you've come to the end of the video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, don't forget to like, subscribe, and turn on the notification bell so you never miss out on more trading tips and strategies. Thanks for watching, and I'll see you in the next video.